What happens when a company beats Wall Street's expectations, but its stock still tanks? That's exactly the puzzle we're talking about today with Dell Technologies. On paper, Dell just posted one of its best quarters ever. Record revenue, massive growth in its artificial intelligence server business, and raised guidance for the full year. Yet the market's reaction was the opposite of what you'd expect. Shares of Dell dropped more than 5% in after-hours trading right after the report. So what's really going on here? Why would investors punish a company that's actually performing better than predicted? Let's break it down step by step, because this story is a mix of market psychology, shifting business models, and the growing hype around AI. First, let's talk about the headline numbers. For the second quarter of fiscal 2026, Dell reported revenue of $29.78 billion, which was above Wall Street's estimate of $29.17 billion. On the earnings side, adjusted earnings per share came in at $2.32, again beating the consensus expectation of $2.30. Normally, those kinds of numbers would send a stock higher. Beating both revenue and earnings estimates usually signals strong execution and demand. But in Dell's case, the stock still moved lower. Why? Because investors aren't just focused on what happened last quarter. They're laser-focused on what's coming next. And that's where things get complicated. The part of Dell's business that's getting the most attention is its Infrastructure Solutions Group, or ISG. This is the division that includes servers and networking equipment, and more specifically, the AI servers that everyone is talking about right now. Revenue in this group surged 69% year over year to $12.9 billion. That kind of growth is incredible, and it's being driven by AI demand. Dell shipped about $10 billion worth of AI servers in just the past 2 quarters and expects to ship $20 billion worth during its 2026 fiscal year. To put it simply, AI infrastructure has become Dell's growth engine, far outpacing its traditional PC business. But here's the twist. While Dell's long-term AI opportunity looks massive, its short-term outlook didn't sit well with investors. For the upcoming third quarter, Dell guided adjusted earnings per share to $2.45. Wall Street was looking for $2.55. That 10-cent gap doesn't sound like a lot, but in the world of quarterly earnings, it's a big deal. Guidance sets the tone for investor expectations, and Dell essentially told the market, hey, our profits might look lighter next quarter. The company did guide revenue higher, $27 billion compared to the $26.1 billion analysts were expecting. But in this environment, earnings per share are what traders tend to react to. Dell explained the softer earnings forecast by pointing to seasonality, especially in its storage business. Storage revenue actually fell 3% year over year in the second quarter, landing at $3.86 billion, compared to estimates of $4.1 billion. Storage is a critical piece of Dell's portfolio, and it tends to do better in the fourth quarter. So Dell is essentially saying that some of the profits investors were expecting in Q3 will actually show up later in the year. That makes sense operationally, but the stock market doesn't always have the patience to wait. Traders wanted smooth, consistent growth every quarter, and Dell is signaling that growth will be uneven. Let's zoom out a bit. Dell also raised its full-year outlook, which is a positive sign. The company now expects revenue of about $107 billion at the midpoint, versus the prior expectation of $104.6 billion. Full-year diluted earnings per share are expected to be $9.55 at the midpoint, topping Wall Street's estimate of $9.38. That means Dell has confidence in its overall trajectory. It's not lowering expectations for the year, it's actually raising them. But because Q3 is expected to be a little lighter, the market is reacting as though momentum has stalled, even though the company believes things will bounce back strongly in Q4. So why does this matter to investors? It highlights a key tension between short-term expectations and long-term potential. On the one hand, Dell's AI business is booming. The company is one of NVIDIA's largest partners, buying GPUs and chips from NVIDIA and building AI servers around them for customers like CoreWeave. With a record $11.7 billion backlog in AI servers, Dell is positioned to benefit from the AI boom in a way few other companies can. On the other hand, the PC side of the business, the old backbone of Dell's revenue, is stagnant. Client Solutions Group revenue, which includes enterprise PCs, grew just 1% year-over-year to $12.5 billion. That's not the kind of growth story investors want. This mix of fast-growing AI infrastructure and slow-growing PCs creates a kind of identity crisis for Dell's valuation. Right now, Dell is trading at about 20.5 times earnings, which is higher than its 5-year average PE ratio of 12.66. That tells us the market is already pricing in some level of AI-driven growth, but compared to the broader S&P 500's PE ratio of about 22.3, Dell is still trading at a discount. For contrarian investors, that could look like an opportunity. A company that's fundamentally strong, with exposure to AI, trading cheaper than the market. But the risk is that if Dell misses near-term execution, its stock could drift lower until investors are convinced again. The other thing to keep in mind is cash flow. Dell generated $2.5 billion in operating cash flow during the quarter and returned $1.3 billion to shareholders through dividends and buybacks. That's a healthy sign of capital discipline. It means the company is not only making money, but also rewarding investors. Still, the market will be watching closely to see how Dell uses that cash going forward. Will it double down on AI investments? Will it pursue acquisitions to strengthen its infrastructure business? Or will it prioritize more buybacks to support the stock price? These are the kinds of capital allocation decisions that can swing sentiment. There's also the question of risks. What if AI demand slows down? Right now, the entire AI industry is on fire, with companies racing to build out infrastructure for large language models, generative AI, and cloud services. Dell is a key player in that supply chain. But if the hype cycle cools off, or if customers decide to delay spending, Dell could feel the impact. And let's not forget, Dell is competing in a crowded space. Other hardware and cloud companies are also chasing AI infrastructure dollars. That means Dell will have to execute at a very high level just to maintain its momentum. Analysts are split, but many remain optimistic. Firms like Morgan Stanley and Mizuho have recently raised their price targets on Dell, with some as high as $160 per share. Citing Dell's leadership in AI servers, the average analyst target sits around $145, which is about 9.6% above where the stock is currently trading. That suggests Wall Street sees upside potential if Dell continues to deliver. But again, the key phrase here is if. Execution in the third quarter will be critical to proving that Dell can maintain its growth trajectory. Let's get real for a second. Dell isn't a pure AI play. Unlike NVIDIA, which lives and breathes GPUs, Dell still has a massive PC business. That means its growth story is a little messier. It has one foot in the fast-growing AI infrastructure world and another foot in the slow-moving PC market. For some investors, that's a turnoff, but for others, it's an opportunity. Because Dell is still generating steady revenue from PCs while using its scale and relationships to capture AI growth. The big question is whether the AI side can eventually outweigh the drag from PCs. From a contrarian perspective, the stock drop after earnings might be a classic case of short-term overreaction. Dell's fundamentals are strong, and the company just raised its full-year guidance. But the market zoomed in on one weak spot, Q3 earnings per share guidance, and decided to sell first and ask questions later. If Dell actually delivers in Q4 as it expects, This could turn out to be a buying opportunity. Contrarian investors often look for situations where the fundamentals tell one story and the market sentiment tells another, and Dell fits that description right now. Still, it's important to recognize the risks. Valuation could revert closer to Dell's historical average if the market decides AI growth won't be enough to offset PC stagnation. Macroeconomic factors, like a slowdown in corporate IT spending, could also play a role. And if competition in AI servers heats up, Dell might not capture as much market share as it hopes. On the flip side, if AI adoption accelerates even faster than expected, Dell's backlog and partnerships with NVIDIA could give it a long runway of growth. The truth is, this is a story that's still unfolding. So where does that leave us? Dell is at a crossroads. Its latest earnings report shows the power of its AI pivot, but also the drag of its legacy businesses. The stock's reaction highlights how sensitive investors are to forward guidance, even when the overall outlook is improving. For long-term investors who believe in the AI infrastructure trend, Dell could be an attractive play, especially at a discount to analyst targets. But for short-term traders, the volatility may not be worth the risk. As always, the decision depends on your investment horizon and risk tolerance. One thing's for sure, Dell is no longer just a PC company. It's evolving into an AI infrastructure powerhouse, and the market is still figuring out how to value that transformation.